Hi everybody, welcome to the new topic, single entry system. But this is not a system actually. There is no system like single entry in accounting. It may be called as incomplete double entry. Incomplete double entry. So under the incomplete double entry system, usually some personal records are maintained and a cash book is maintained. The businessman is concerned with the personal records and cash book. Cash book is very important. You know that. And some personal records are maintained. And the details like expenses, incomes are not maintained under this incomplete system. So it is not a system, it is an incomplete system. But profits can be ascertained under this system. How much profit the business earned during a particular period. And it is as accurate as the profit calculated under double entry system, trading profit and loss account. The profit calculated under single entry system and double entry system will be always equal. It is not inaccurate. But due to lack of informations regarding how much expenses incurred, how much incomes earned during the period, due to this lack of informations, we need to find the profit of the business in a particular way. Provided you know only one equation that we have already studied. If you know this equation, double entry or single entry is nothing. That you know the equation. Already you know. What is that equation? We have studied assets is equal to liabilities plus capital. If you know this equation, nothing prevents you from studying accounting. So this is important. So this equation we know. Assume assets are 100 rupees, 100. So 100 is equal to, and assume liabilities are 40 rupees and capital is 60. So the values of assets are 100 rupees and liabilities are 40 and capital is 60. So 100 is equal to 40 plus 60, true. And even a million transactions never change this equation. Always assets is equal to liabilities plus capital. But the figures may change. Assets, the amount of assets may change, liabilities may change, capital also will change. If you understand this equation thoroughly and properly, then single entry, double entry, partnership, joint stock company account, nothing before this equation. Because accounting is primarily based on this equation. And this is the business of the accountant. These assets are contributed by owners and creditors, liabilities. And these assets we give a special status. That status is called a business entity concept. So business means resources, assets. Certain assets are there. These assets may be business assets, that is grocery, bank, any company, say joint stock companies, sole tradership, in any business, assets are there. And we give these assets a default value, you know that, debit. And liabilities we give credit. And capital we give credit. You know that. I have uploaded one topic on introduction to accounting. These are all clearly mentioned over there. So in any business, at any point of time, if we apply this equation, always the resources of the business will be equals to liabilities plus capital. And due to this business concept, these assets we give a special status. And that is business for the accountant. Whether it is a trust or a cooperative society or a bank or any business organization, the assets we give a status apart from the persons who contributed these assets to the business. And that concept is called a business entity concept. Accounting, double entry bookkeeping is there in cooperative societies where the motive is not profit making. So in accounting, business has a separate meaning. The property set aside gives a special status. These properties may be contributed by the owner primarily or owners primarily, and some properties may arise from third parties also. And there are three parties to the business. The first party is business, second party is owner, and the third party is liabilities. That is why we studied amounts due to third parties. The first party is business because of the business entity concept. Business is treated as a separate person apart from the owner or third parties. So business is the first party. And the business always consists of certain resources. And these resources are called assets. And the values of these assets will be always equal to what? Liabilities plus capital. And to this default values, assets always debit, default value is debit, and liability is credit, and capital also credit. You know all these things, but you have to understand this. If you understand this, nothing, accounting is nothing, everything is here. Everything you want to know about accounting. If you understand these three terms thoroughly and these default values, that is very important. This debit and credit arise in double entry only. In single entry it is not there. But in single entry we can apply this equation. And this equation gives a debit and credit by the accountant. Then only double entry coming. Other than debit and credit, assets is always equal to liabilities plus capital, whether in single entry or double entry. That is very important. And this is typically shown in a balance sheet, whether in the vertical form or a horizontal form. Assets are shown on the asset side and liabilities are shown on the liability side, and capital is there. If assets are 100, liabilities say 40 rupees and capital will be 60. And the default values of assets are debit, liabilities are credit, and capital is credit. We need to analyze this equation. Then single entry, double entry is nothing. We have to understand this equation. For that purpose, we need to rearrange this equation. So, assets are 100 rupees, correct? So, 100. Liabilities are how much? 40 rupees. So 100 minus 40 is equal to 60. Correct? So we need to rearrange this equation. Assets minus liabilities, we get what? Capital. So we will rearrange this equation. First, assets minus liabilities is equal to capital. Correct? No doubt? And this equation we follow. It can be applied to any business. From the assets of the business, deduct liabilities to third parties, we get owner's capital. And this owner's capital, we need to call it as, other names are also there. After business operation, this capital will be increased by what? Profit. Correct? No doubt. We have studied all these things in +1. We studied a lot about double entry bookkeeping. So after a certain period, from the assets, if we deduct liabilities, what we will get? Capital plus profit. The other name of capital plus profit is, we can call it as net worth. Net worth. What is that? Net worth. Or equity. Some little bit standard we have to apply. Assets minus liabilities is equal to capital or capital plus profit. If there is a loss, that should be deducted. Capital plus or minus profit or loss, we can call it like that. Otherwise, we can call it as net worth. What is that? Net worth. The net value of the business. And this is the value of the business. From the assets of the business, say 100 rupees, amount due to third parties are settled, what we will get? The owner's amount. That is why it is called equity. Owner's right. Equity means right. Owner's right in the business. And owner's right in the business includes capital plus a profit. If there is a loss, that should be deducted. You know all these things. So in any business, if we deduct liabilities from the assets, we get what? Net worth. We call it as net worth. Then we need to study how these values changes. Due to the business operations, then what are called business transactions? Any activity or event that makes a change in the property. The property means business. Any change or activity that makes a change in the properties of the business are called business transactions. There are numerous millions of business transactions in big business houses. In every second, thousands of transactions are happening. And all these transactions makes a change in the assets and liabilities of the business. That we need to study first. Each and every transaction may change assets and liabilities, and some transactions may change capital. So what are all the sum transactions? And these sum transactions we need to understand first. Why this capital changes? And we know The default values of assets are debit and liabilities are credit and capital is credit. Capital is always credit. And capital increases due to what? Profit. Assets minus liabilities, we get capital plus profit or minus loss. And that is otherwise called as net worth or equity. Then see assets, liabilities and capital. Debit, credit, there is a big credit in capital. And because of this credit only, capital changes in any business, whether it is in double entry or single entry or small proprietorship or joint stock company or partnership. Capital of a business changes only on account of profit. And that profit is a result of another debit and credit. Another debit and credit. That another debit and credit is not considered in single entry system. That is what we are studying now. There are several numerous of business transactions. If these business transactions are confined to this only, assets and liabilities only, it never changes the capital. That we have to understand. A million transactions in between assets and liabilities only, that never brings a change in the capital. You write several million journal entries where one aspect is asset and another is a liability. That never changes capital. For example, say 100 rupees is the total asset. Liability is 40. If we pay 10 rupees to a creditor, capital never changes. See, take an example. Out of 100 rupees cash, 10 rupees paid to a creditor. How much assets becomes? 90 rupees. Minus liabilities, how much will come? 30 rupees. Is equal to 90 minus 30, how much we will get? 60 rupees. When cash paid to creditors, what is the entry? Creditors account debtor to bank for cash. Creditors account debtor to bank or cash. That is the entry. So even a million transactions in between assets and liabilities only, that never brings a change in the capital employed or the capital or the net worth. Then what transactions make a change in the capital? That we have to study now. And here assets, liabilities and capital. A big credit will come. Because of that credit only, a business grows. That means the capital grows. All the accountants are sitting, debiting, crediting throughout the year, and an account is drawn up. That account we know. Trading and profit and loss account. What is that? Trading and profit and loss account. We can call it as income statement. Income statement. So if the transactions are confined to assets and liabilities only, that means both the debit or credit aspects are either assets and assets or liabilities and liabilities or assets and liabilities only. Cash paid to creditors, cash received from debtors, bank is increasing, debtors are decreasing. Purchase of goods, even purchase of goods never makes a change in the capital. 1,000 rupees goods are purchased and paid cash. So cash account is decreasing and stock account is equal amount is increasing. So if both the aspects are assets and liabilities, it never makes a change in the capital. Then which transaction makes a change in the capital? I told you one more debit and credit is there. And those debits and credits are expenses, then incomes. And these expenses and incomes makes a change in the capital of any business, from small business to big business houses. And the records of these expenses and incomes are not there in the single entry system, incomplete double entry. These debits and credits are not there in the single entry system. And all the expenses decreases capital and all the incomes increases capital. Examples? Several examples are there. Rent, salary, commission paid. Purchases is not an expense till it is sold. That is why we take into account cost of goods sold. Cost of goods sold or cost of service is the major expenditure, and revenue, income from sales or other revenue is the main source of income of any business. And after incurring each expense, capital to be deducted, and after gaining some incomes, it should be added to the capital. We get the same capital in the balance sheet at the end of the year. But there are millions of transactions concerning incomes and expenses of a business. So what the accountant do under double entry system, he will prepare an income statement. He will prepare an income statement. That income statement has two sides, debit and credit. On the debit side, we write all the expenses, consolidated expenses. And expenses payable also written. And these expenses, whether it is paid or payable, reduces capital, and all the incomes increases capital. So the expenses are consolidated and debited in the income statement. Say 1,000 rupees. And incomes say 1,500. And these expenses are set off against the incomes, and the net profit. How much is the net profit? 500 rupees. And this 500 profit is carried to the balance sheet. And that is why it is a net credit. That is why I said there is a big credit for capital. And this is the major business transactions in any business. Cost of goods sold and sales. Sales are happening every second. Purchases are happening. Expenses are incurring. Numerous expenses are incurring on a daily basis. It is very difficult to deduct each and every expense from the capital. That is why these debits and credits are taken out from these debit and two credits. Because these debit and credits always results a change in the capital. Expenses decreases capital, incomes increases capital. And this balance sheet has no debit or credit. The assets, liabilities and capital. The start of the business and end of the period also the same thing is there. There is no debit and credit for assets, liabilities and capital concerning balance sheet. But in double entry, when we start a business, we give debit, credit and a credit to the capital. Then all the items, all the transactions which makes a change in the assets, liabilities and capitals are recorded. Out of those transactions, only expenses and incomes will makes a change in the capital. And there may be thousands of expenses and incomes, and in a particular year, all these expenses are consolidated and written on the debit side of the trading profit and loss account, and incomes are credited, and the net amount is taken out. That may be either profit or loss. That profit or loss is carried forward to the balance sheet. We know that. Trading profit and loss account, we know. Income statements, everything. Assertions also, we call it the same thing. Instead of income statement, income and expenditure account. Instead of profit and loss account, we are saying income and expenditure account. Expenditures are debited like expenses and incomes are credited, and we call it the difference as not net profit but surplus. That's the only difference. Both are same. Expenses, revenue account, maybe call it as revenue account. Different names are there. We call it as income statement. That is the correct thing. All the expenses are written here and all the incomes are written here. The difference is treated as profit. And this income statement cannot be prepared under single entry system. And we studied assets minus liabilities is equal to capital. So, in the opening, there may be certain assets and liabilities. The difference will be opening capital. And at the end of the period, we prepare another balance sheet, assets, liabilities, and the balancing figure may be capital. And capital in the beginning is say 5,000 rupees and capital at the end is say 7,000 rupees. The difference 2,000 will be exactly equal to the net profit carried to the balance sheet. And this income statement is prepared under double entry system because there are both the aspects we are considering. But in single entry system, only statement of assets and liabilities we are maintaining. And we call it as statement of affairs. Finding out the opening capital. And capital increases due to what? Profit. So the difference between the opening capital and closing capital will be treated as either profit or loss. And this term we call it as net worth. Correct, no? We call it as net worth. So net worth in the opening and net worth at the end of the period are compared. And increase in net worth will be exactly equal to profit. And this profit we are carrying forward in the double entry system in the balance sheet. And without writing the profit and loss account, if you write the balance sheet at true values, the balancing figure will be profit. No doubt about it. Both in single entry and double entry, the profits reported will be 100% accurate, provided all the assets and liabilities are shown at their true values. And this method is called a net worth comparison method. So under incomplete system, we need to prepare a statement of assets and liabilities in the beginning and a statement of assets and liabilities at the end, and capital at the end less capital in the beginning, we get profit. This is the thing. Opening capital and closing capital, the difference is definitely profit or loss. And this method is called net worth comparison method. Because of lack of information, this income statement cannot be prepared under incomplete double entry. What we are doing then, we know the big credit, it is due to profit. So from opening capital, say 5,000 rupees, and at the close of the year, if we calculate another capital, if it is 7,500, then we can simply say that 2,500 is the profit. If a person starts a business with 100 rupees in the morning, and if we have 150 rupees at the end of the day, 50 rupees is the profit. His net worth in the beginning is 100 rupees, and net worth at the end of the day is how much? 150. Capital comparison method or net worth comparison method. We cannot call it as simply capital. Net worth, net assets. That is what we are studying here. Net worth comparison method. And there is no debit and credit for the balance sheet. Only assets, liabilities, capital. Opening balance sheet, that here in incomplete double entry system we call it as what? Statement of affairs. Statement of affairs. Statement of affairs. This is like a balance sheet. Assets are shown on the asset side and liabilities are shown. The balance sheet figure taken out as capital in the beginning. And another statement of affairs we have to prepare, that statement of affairs at the end of the period. Then closing capital is calculated. The difference between opening capital and closing capital will be treated as what? Profit. It will be exactly equal to the profit and loss account balance shown as per profit and loss account or income statement. This may happen in any business if business records are lost due to an accident, fire, etc. In such circumstances, from the available records, we prepare a statement of affairs. The difference between opening capital and closing capital will be treated as profit or loss. If a small businessman approaches a bank for taking loan, the bank will always ask for a balance sheet. Okay, bring your balance sheet. Then he immediately go to a chartered accountant and ask for a balance sheet. So this, from the incomplete records, then there is another method, conversion method is there. This single entry is converted into double entry by putting debit and credit. That is the only difference between double entry and single entry. In incomplete double entry system, there is no debit and credits. Only statement of affairs are prepared. And after that, we put debit and credit. It is called a conversion method. From the available records, we put debit, credit, then a trading profit and loss account is prepared, then the balance sheet. There are two methods for finding out profit under incomplete double entry system. First one is net worth comparison method. And another important thing, you see, a person has started a business with 100 rupees in the morning. Say 100 rupees in the morning. And he have 150 rupees at the end of the day. What is the profit? His net worth in the beginning is 100 and net worth at the end is 150. So capital at the end. Capital at the end. How much is that? 150. Less capital in the beginning, 100, we get profit. Suppose in the middle of the day he has taken 10 rupees for lunch, personal drawings, not a business expense. And what are all the expenses incurred by him? We don't know. But this information is there. He have taken 10 rupees for personal purpose. And that is called a drawings. We know that. If that 10 rupees also there, this 150 would have been 160. So we have to adjust the capital at the end by adding simply drawings made by the owner. Add drawings. 160 less 100 capital in the beginning. 60 rupees is the profit. If that drawings were not there, the capital at the end would have been 160. That is the concept behind it. You know that. Simple thing. Simple example. And this comparison method is called, a net worth comparison method. And net worth is calculated by net worth you know, simply assets minus liabilities. So opening statement of affairs we have to prepare, closing statement of affairs we have to prepare, and the difference in capital will be treated as profit or loss. By doing so, if there is any drawings, that drawing should be added back. Likewise, if we have introduced another 20 rupees as additional capital, and this additional capital will be deducted from here. So added drawings less additional capital, then we get the adjusted capital. Drawings will be added back and the additional capital will be deducted. Because to that extent, business profit has not arisen. You simply calculate with it. 100 rupees in the morning and 150 at the end of the day. And in the noon, I have taken say 10 rupees for lunch and another 20 rupees I introduced. Even then I have 150 rupees. Then I have to calculate profit. To the 150 rupees, add 10 rupees withdrawal. Okay, 160. And 20 rupees is additional capital. So additional capital should be deducted. And there is a formula for that. Simple thing, these are all. Only thing you have to know, you need to know is this capital changes only because of expenses and incomes. And these expenses and incomes are not, records are not available under single entry incomplete system. But we know capital changes only because of profit. And profit is a result of expenses and incomes set off. So this difference between opening capital and closing capital will be always the profit. And while doing so, if there is any drawings, that drawing should be added back. And if there is any withdrawal, that withdrawal should be deducted. And there is a formula for that. What is that formula? So under net worth comparison method, what are all the statements we have to prepare? Capital at the end we have to adjust with the drawings and additional capital. So capital at the end we have to prepare by preparing a statement of affairs at the end of the period. Statement of affairs is nothing but a balance sheet. We know what is balance sheet. From the available information, prepare a statement of affairs in the balance sheet format. We call it a statement of affairs, not balance sheet. Balance sheet is a term related to double entry. And that is why we call this balance sheet as a statement of assets and liabilities as a statement of affairs. So capital at the end is written. To that add drawings plus additional capital, we get adjusted capital. While comparing two figures, an accountant should be always careful. Comparable figures only compared. A horse should be compared with a horse only, not with a cow. $1 and 1 rupee never becomes 2. I have $1 and 1 rupee. I have 2 rupees. I cannot say like that. So only comparable figures should be compared. This capital changes only because of 3 items that we need to understand. The first thing and major thing is on account of profit or loss. Then next on account of withdrawals. On account of withdrawals, drawings. And next is additional capital brought in. These are the three transactions that affect capital, and all other transactions never affect capital. Profit or loss, additional capital, drawings. And in partnership, it comes to be interest on capital. These are notional items, not real items. If interest on capital is allowed, capital will be increased by that much. Interest on drawings is there, capital will be reduced by that much amount. So to the capital, at the end of the period, add drawings less additional capital. Why these are all adding, we already covered. First you have to understand that. Without understanding that, don't buy out all these things. An accountant never buy out anything. If you buy out these formulas and all, if a different problem arises, a different text comes, you will be in trouble. So understand what is behind, why it is adding, why it is deducting. Understand that first. The only formula is capital changes only because of profits. The other changes due to drawings or additional capital. Why additional capital is deducted? Because of the comparison, we have to adjust the values. $1 and 1 rupee never equals 2. Because capital at the end includes additional capital. So in order to compare with the opening capital, this additional capital is to be deducted. Why? Not capital at the end. Capital at the end includes additional capital, so that should be eliminated for comparison purpose. If drawings were not there, capital at the end would have been increased to that extent. So drawing should be added back in order to have a comparison, meaningful comparison. So adjusted capital at the end we got, from that deducted capital in the beginning, we get a net income or profit. In double entry also the same thing is there. The capital changes only due to profit and drawings and additional capital. Okay, and in the conversion method, we have to trace out all the transactions, and by putting debit and credit, that is the job of accountant. The double entry starts after the equation only. To the assets minus liabilities plus capital. So assets minus liabilities is equal to capital. We put the default values, debit, credit and credit. Okay, so we need to do some text and solutions. First of 5 simple problems. First we will finish 5 simple problems, then go to advanced text. Okay. So under the single entry system, profit can be ascertained in 2 ways. First method is statement of affairs method or net worth comparison method. You know what is net worth. So under the net worth comparison method, net worth is to be calculated. Capital should be calculated. Opening capital and closing capital. For that, we have to prepare 2 statements. The first one is statement of affairs in the beginning of the year and at the end of the year. Correct? Read the question first. What is there in the question? Mr. B commenced a business so and so. So with a capital of 26,000. So opening capital is given. So there is no need of preparing statement of affairs in the beginning of the period. Then what is in the question, ascertain the profit or loss made? Here it is very important. Prepare trading profit and loss account and the balance sheet. That is conversion method. Profit and loss account and balance sheet is a term related to double entry. So we have to convert this information into double entry by putting debit and credit. That is the difference between single entry and double entry. There is no debit in the single entry. But in double entry, debits and credits are there. That is not in the single entry system. Even we cannot say that one entry is using there. Certain accounts are maintaining. Okay? So, soon thereafter, he bought a furniture and fixtures. He bought furniture and fixtures for 3,000 rupees. Soon thereafter means immediately. That means on 1st January 2004 immediately. Okay? On 30th June 2004. So this is an additional asset purchased. On 30th June 2004, he borrowed 5,000 rupees from his brother at 10% per annum. It is a business transaction. Because he borrowed 5,000 rupees from his brother at 10% interest per annum. Loan is a liability. Whether it is taken from bank or brother. So this is a liability. He borrowed 5,000 rupees and at 10% per annum, interest not paid. So interest outstanding is also there. If it is paid, it will be there in the profit and loss account. But under the statement of affairs method, we are not preparing profit and loss account. Why it is so? Increase in capital is always treated as profit. That we have studied in the introduction topic. Okay? So, once again, Mr. B commenced business on 1st January 2004 with a capital of 26,000. So this is opening capital and there is no need of preparing statement of affairs in the beginning of the year. Soon thereafter, he bought furniture and fixtures rupees 3,000. This is an asset purchased. Depreciation may be there. Here date of purchase is not given, but immediately after 1st January 2004. That means the asset has been purchased in the beginning of the year. So if there is any depreciation, full year depreciation have to be considered. Okay? On 30 June 2004, he borrowed 5,000 from his brother at 10% per annum. It is borrowed and having an interest rate of 10%. So it is a loan taken by the business. It is a liability. Loans are liabilities. You know that. You have prepared trading profit and loss account. Financial statements you already prepared. You know that. Without knowing that, we cannot do this. So the borrowals of the business are known as loans. Whether it is from the bank or brother makes no difference. Okay. So at the closing statement of affairs, we need to show furniture and fixtures as an asset, less depreciation, if any. And this loan, 5,000 rupees, should be treated as a liability. And interest thereon is not at paid. So interest at 10% per annum, that also should be considered. Per annum, per year, 10%. When he taken on 30 June 2004. What is the closing date of statement of affairs? 2004, 31st December. So only 6 months interest is outstanding. So 10% of 5,000 is 500 rupees. So 250 is a loan outstanding. So we know that furniture and fixtures, furniture etc. to be shown as an asset at the end of the statement period, statement of its. The next one is, and introduced a further capital of his own. This further capital, additional capital. So additional capital is there. So additional capital, we know additional capital should be deducted from the capital at the end to make it comparable. We know that. He withdrew at the rate 500 per month at the end of each month for household expenses. Household expenses are household expenses, not business expense. And these are called drawings. Okay. So drawings information is there. Additional capital information is there. He purchased an additional fixed asset and a loan has been taken. These are all to be considered while preparing the statements and statement of profit and loss. In the statement of affairs, we have to consider only assets and liabilities at the end of the period. On 31st December 2004, his position was as follows. Cash in hand, cash at bank, debtors, stock in trade, bill receivable, creditors, owing for rent. Yes, an additional outstanding is given. Here loan interest outstanding is there. Remember that. Owing for rent, 450. It is a liability. Expenses outstanding is a liability. Furniture and fixtures are to be depreciated by 10%. So 10% depreciation to be deducted from furniture and fixtures in the closing statement of affairs. When this furniture bought soon after 1st January 2004. So full year depreciation is to be provided. In the statement of affairs, we need to consider only assets and liabilities at the end of the year. Opening assets and liabilities will be considered in the statement of affairs in the beginning. Here not required. Then opening capital and closing capital should be calculated. From the closing capital, this capital should be adjusted with the drawings and the additional capital. Here additional capital is there and drawings is there. Drawings should be added back and additional capital should be deducted. Simple thing. And adjusted capital, difference between adjusted capital and opening capital will be treated as profit or loss. Some questions may ask, find out trading profit also. Then we will be careful. Next question we will do like that. Trading profit separately and net profit separately. Okay, then we can prepare one statement of affairs at the end and find out the closing capital. To this closing capital, add drawings, deduct additional capital. What we will get? Adjusted capital, comparable capital we will get. And this capital is not just capital, we can call it as net worth. And net worth at the end of the period and beginning of the period will be, the difference will be either profit or loss. Okay, we can make the statement of affairs at the end of the period. So we can prepare a statement of affairs. All these closing assets and liabilities we have to show in the statement of affairs at the end. Opening not required. Okay. Cash in hand, cash at bank, sundry debtors, stock, bill receivable, these are all assets. Sundry creditors and owing for rent outstanding, liabilities. Other than this, one important information is here. He borrowed 5,000 from his brother. Loan from brother, liability. Not only that, this interest 10% per annum for 6 months has not paid. How 6 months come? He borrowed this loan on 30th June 2004. So only 6 months interest is outstanding. So this is a liability. It will be shown on the liability side of the statement of affairs. And if drawings is there, added to the capital at the end. After ascertaining, capital at the end. Additional capital is there, that should be deducted. And this rent outstanding shown on the liability side of the statement of affairs. And it will be look like this. Statement of affairs of Mr. B as on 31st December 2004. Furniture 3,000 was there. Depreciation at 10% per annum. He immediately bought that furniture as soon as the business commenced. So full year depreciation has to be provided, full year. Like a loan, this furniture was purchased on 30th June, only half year depreciation has to be provided. Proportionate depreciation. That you have studied in depreciation chapter. Okay. So here full year depreciation. Then cash in hand, cash at bank, bill receivable, sundry debtors, stock in trade, etc. or assets. If there is any prepaid expenses, that will also be shown in the statement of affairs as an asset. And liabilities are loan from brother 5,000, interest outstanding for 6 months. That is also a liability. And this interest etc. are not to be considered. Without preparing the profit and loss account, we are calculating profit. The increase in capital is treated as profit. We know that. First understand the introduction chapter very well. It will be usable during your entire life. Okay. Then sundry creditors. Sundry creditors how much? 1,200 rupees. Rent outstanding 450. That is all there in the question. And higher side to be calculated, total balanced 26,200 rupees is the balance here. That will be treated as capital at the end. Then prepare a statement of profit or loss made by B during the period 31st December 2003-04. This capital at the end will be shown first, added to this drawings. How much was the drawings? It was, he withdrew 500 per month at the end of each month. So how many months in a year? 12 months. So 500 into 12, 6,000 rupees is the amount of drawings. And the additional capital here is 6,000 rupees. Additional capital to be deducted. We know that. Then he borrowed 5,000. This already shown in the statement of affairs. Okay. Furniture also shown. These are all we have taken. Then now we can prepare a statement of profit or loss. Statement of profit or loss. Capital at the end as calculated. Okay. Added drawings 500 per month for 12 months, 6,000. Less additional capital 6,000. And this is adjusted capital. Adjusted capital. Then after that what to do? Less capital at the beginning. Beginning of the year. Opening capital. Opening capital was how much? So less capital at the beginning of the year, 26,000. Adjusted capital, 26,200. How much is the difference? 200 rupees. Profit how much? Net profit for the year. Adjusted capital less opening capital. It is profit, 200 rupees. Okay. So once again, capital at the end, 26,200. Added drawings, 6,000. It is 32,200. I have deducted this side. No problem. So less additional capital, 6,000. How much here? 26,200. Is equal to this minus this. 26,200. So capital at the beginning of the year, 26,000. Net profit for the year, 200. Okay. So now time is over, and in the next part, I will come up with some advanced problems. 2-3 simple problems more we will do, and after that advanced problems will come up to CA Inter. We will cover this subject. Before that, you study the concept behind this capital comparison method. You study the equation, accounting equation, understand the accounting equation. What is there? Assets minus liabilities, what? If you understand that these are all simple things, then in our example, 100 rupees becomes 150, 160 like that. That example also you study well. These are all simple things. All the expenses result in decrease in capital, and all the incomes increases capital. And these expenses and incomes are set off, and the net amount is taken to the balance sheet as in the double entry system. And in the single entry, we are not considering the expenses and incomes. And the difference is find out by preparing a statement called a statement of profit or loss. Here we are comparing the capital, comparison of net worth. The increase in capital will always be equal to the net profit as shown by the profit and loss account. And both the method, in double entry as well as single entry system also, profit will be same. Okay. So see you. Study well. Don't forget to subscribe our channel. New topics are coming. So subscribe and press the bell icon. Okay. Thank you.